Hey everyone, it's Bob with another FinOp Controller webcast. This week we're going to switch it up for the reserve calculation. We're moving on from the customer credits. We're moving over to the debit side. We're going to take a look at line 10, cash and margin debits this week. So let's talk about some of the questions we're going to answer this week with regarding customer debits and the reserve calculation. What makes an account properly collateralized? Suppose there's some collateral in the account, but not enough. What can be done? Can the debit be used? Do debit amounts have to be recorded in the account before they can be included? If an affiliate, a principal, and a household account are considered customers, can those debits be included in the calculation? Is it possible to have both a customer and a non-customer in the same account? And if so, can that debit be included? And finally, what happens if the customer uses the account like a checking account, or if they purchase things other than securities? Can those debits be included in the reserve calculation? Before we get started, let's do a quick review of the reserve calc. In prior webcasts, we've gone through lines 1 through 9 of the reserve calc. Those are for the credit categories. Now we're about to start on the debit categories for the reserve formula, and you can see here we're discussing line 10, which is the debits in the margin and cash account. All right, before we get started, a few disclaimers and notes. First thing is that this presentation is for educational purposes only. It's not legal advice. If you have to do an actual reserve calculation, I'm going to refer you to the FINRA website where you can get their interpretations for financial and operational rules. In addition, I think the best way to make use of this presentation is to review it versus your firm's calculation and compare the items we're discussing today. Let's talk about the items that can be included on line 10, receivables from customers. First one is that customer cash and margin accounts in a debit status. Be aware, though, that the debit has to have been created when the firm extended credit for the purchase of securities, and also that the account is properly collateralized. 2 and 3 are accruals. One is for interest receivable on fully secured customer accounts, or if you are charging custodial fees for IRA accounts, you can include that accrual also. And also any dividends and interest receivable from DTC has to be outstanding 5 days or less. It's got to be related to credits in the formula. In other words, the firm credited customers before receiving funds. This generally will occur when the dividend pay date is on the day you're doing the reserve calculation. Say, for example, on that Friday, that's the dividend pay date. The firm credits its customers. The next day, DTC will go ahead and send the money. All right, we've talked about what can be included in the reserve calc on line 10. Let's talk about items that cannot be included or have to be excluded. First one is unsecured debits. Number 2 is the unsecured portion of partly secured debits. The amount you can actually include into the reserve calculation is the market value of the underlying security less any charges known as haircuts on that particular security, and to do that, see your net capital rules. If you have restricted or controlled securities within an account, they cannot be used as collateral. Debits from non-purpose loans, also known as security-based lines of credit. These loans are collateralized by securities. However, they are used for purchases other than stock, say, for example, boats, cars, houses, weddings, etc. Accrued trade date commissions can't be used. The reserve calculation is performed on a settlement date basis. Therefore, these amounts would be excluded from the calculation. Other items that need to be excluded are any debits related to affiliates, principals, and household members' security accounts, and that includes both their cash and margin accounts. You can include these debits if they are related to items on the credit side, say, for example, if the securities are embedded in bank loans or stock loans, if they're related to fails to receive, or if they're related to customer, non-customer, proprietary PAB short items. To determine whether they are related, you're going to use the stock allocation report, and that can be used to demonstrate that debits from the above accounts are related to credit items in the reserve formula. Be aware also that if you have affiliate accounts and they're not used for the purchase of securities, they should not be in the customer ledger range of accounts. This occurs, say, if there are intercompany receivables, payables, loans, etc. If your customer accounts are linked to a bank or a money market sweep product, any debits that are created from these processes have to be excluded from the reserve calc. Back in the late 1970s, banks were competing with broker-dealers for funds. The broker-dealers were able to link a money market mutual fund to a customer's account. Therefore, any deposits made by the customers would automatically be swept or purchase shares in the mutual fund. At the same time, they would issue customers checks that can be used against the account. Customers would then go and use the checks for purchases. Banks would present the checks to the broker-dealers, and the broker-dealer would pay the bank, which would require them to debit the customer's account. At the same time, they would issue sell instructions to the money market mutual funds to cover the debit in the customer's account. When that happens, there is a debit in the customer's account. The SEC has determined that that debit did not arise from the sale or the purchase of securities on credit, and therefore the debit is not allowable for the reserve calculations. So if your customers are doing this type or have this type of product linked to their account, then you've got to have a process in place that allows you to exclude or remove those amounts from the calculation. All right, now we're going to talk about concentration charges. Concentration charges are reductions in the amount of debits that can be included in the reserve calculation, and they occur when either a customer's account is greater than 25% of tentative net capital, or if an individual security issue that is part of the collateral of these margin accounts is greater than 15% of the total collateral that's allowed for the margin accounts. Let's talk about the customer accounts first. Here, you're going to compare it versus the tentative net capital of the firm, and that's the firm's net capital before inventory charges, also known as haircuts. In addition, be aware that this is not done on an account-by-account basis. First of all, you're going to have to sum up all related accounts under common control, and common control can be found by finding accounts that have the same address, the same tax ID numbers, cross guarantees, linked accounts, etc. There, you're going to sum up all the account balances, and you're also going to gross up the balance by removing any short sale credit balances that are in these accounts. Once you've determined what the balance is, then you're going to exclude any amounts greater than 25% of tentative net capital. However, there's an exception to this rule, and if you can prove that the excluded amount is related to items on the credit side, then the amount can be included as a debit in the reserve calc. The firm is also going to take a concentration charge if the customer collateral held by the firm is concentrated in a few security issues. And this will occur when any one particular security makes up 15% or more of the market value of all the securities used for collateral. I think the best way to demonstrate this is to look at an example. And we're going to flip over to the second slide and take a look at it as an example of a security concentration charge. You're going to do this for every security that has a charge or has a market value greater than 15% of the total market value of all the collateral held. So let's see how we do this calculation. First of all, you take the aggregate margin balance, and this is all of the margin balances that you've lent to your customers. So that's $250 million in this example. The maximum amount of collateral that you can use on a $250 million balance is 140%, and therefore the total market value of the collateral is $350 million. 15% of that is $52.5 million. Now, if you have any security, one issue of a security that is used as collateral for the margin accounts, and it's greater than 52.5, then you're going to be taking a charge on it. In this particular example, we have one that's 100 million. We subtract off the threshold of 52.5, and that gives us an excess of $47.5 million. Now, $47.5 million is not the total amount we're going to exclude from the reserve calc. We have to convert that back to the margin debit balance, And you do that, you divide by the 140% that you multiplied the aggregate margin balance with originally, and therefore your concentration charge, the amount you're going to subtract, is approximately $33.9 million. Finally, let's discuss what to do if you have a joint account that includes both customers and non-customers. If the non-customer ownership percentage is less than 5%, you can include the entire debit. If that non-customer ownership percentage is between 5 and 50%, then you must exclude the non-customer's debit amount unless it can be shown that it's directly related to a credit in the reserve. And finally, if the non-customer's debit percentage is 50% or higher, then you must exclude the entire debit amount unless it can be shown that the amount directly relates to a credit in the reserve. And again, to demonstrate that it's related to a credit in the reserve, you're going to use the allocation program. That program must be able to identify non-customers from customer securities within a particular account. If you have any questions on the material we've covered today, send me an email at bob@rmmilburnconsulting.com. Thanks again for listening.